You just retired, or maybe you're a few months away from it. And in the next year, you're going to make more financial decisions than you've made in the entire last decade combined. Most people don't know that. They retire, they tell everybody, they start planning trips, the family starts asking for help. And somewhere in the middle of all that, the most important structural decisions of their retirement get made on autopilot. I've watched families do this for 31 years. The first 12 to 24 months after you stop working, that's the window. That's when the tax tone for the next 30 years gets set. That's when the survivor plan either works or it doesn't. And that's where a couple of quiet decisions either save a family hundreds of thousands of dollars or quietly cost them the same. So in this video, I'm going to walk through 10 upgrades that I tell all the families I work with to handle before they tell a single person they've retired. These aren't luxury upgrades. Nobody's buying a boat. These are the financial, legal, tax decisions that determine how well the next 30 years are actually going to go. You see, the families who get these 10 right before the celebrations start, they keep significantly more of their money. And the ones who don't, they spend the rest of their retirement quietly paying for decisions they didn't realize they were even making. My name's Chris McClure. I've been a financial advisor for 31 years, and I put these videos together about once a week. It's honest information for high net worth families who have worked too hard to leave money on the table. So the first upgrade number one, and it's the biggest one, it's your withdrawal strategy. For 30 or 40 years, you had one job financially. Save as much as you could. Put it into the right accounts and let it grow. And that was the whole game. And the moment you retired, the game flips. Now the question is, which account do you pull from? How much should I pull and in what order? And most people default to the traditional IRA because that's where the bulk of the money sits. But every dollar that comes out of that account creates ordinary taxable income. It stacks on top of Social Security, and it pushes Medicare premiums up through IRMA, which is the tax rules on Medicare. And once you start pulling heavily, you've quietly set the tax tone for the next 30 years without realizing it. So before you spend a single dollar in retirement, you want to know which accounts you're pulling from in year one, which years are your best window for Roth conversions, and how to keep taxable income controlled while you're still in lower brackets. And this is way before required minimum distributions force the issue at age 73 or 75. The families who upgrade this first, they make better decisions for the next 3 decades. The ones who don't, they pull whatever's easiest to access, and they're still paying for that default choice 20 years later. Upgrade 2 is your health insurance. If you're retiring before 65, your employer coverage is ending and you need to bridge those years to Medicare. And it's not something you figure out after you leave. You figure it out before your last day. Marketplace coverage through the Affordable Care Act offers premium subsidies based on your income. They actually tightened those subsidies in 2026, but there are still some meaningful subsidies, and the withdrawal strategy that you just locked in for upgrade 1 determines how much those subsidies are actually worth to you. With the right income structure, you're looking at tens of thousands of dollars in savings across those gap years, the year between you retire and the year you go on Medicare. With the wrong structure, those subsidies disappear entirely. You also have something called COBRA. COBRA is available, it's expensive, and in most cases, the marketplace coverage with a managed income strategy beats it, but you have to model this before you retire, not after. Notice what just happened here. Upgrade 1 quietly drives upgrade 2. It's not an accident, it's how all 10 of these work together. Upgrade 3, and another important one, is your tax plan. While you were working, tax planning meant maxing out your 401k and maybe itemizing. That's about it. In retirement, the tax plan covers the next 25 or 30 years. And the decisions you make in year 1, they actually ripple throughout those years. Bracket filling, Roth conversions, capital gains harvesting, Medicare IRMA management, all that starts the day you stop work. Most retirees, they don't upgrade their tax plan until they file their first return in April. They sit down with their CPA and the CPA says, well, we could have done a few things differently, but the year's income is already locked in motion. That window, that tax window is gone. So you want to upgrade to a lifetime tax model, and you want to think about it before you start spending. Every withdrawal, every conversion, every income decision made with the full 30-year picture in mind, not just this year's tax bracket. You see, that's a different way of thinking about taxes than almost anybody is doing on their own. Upgrade number 4 is your beneficiary designations. Most people set these beneficiaries up when they opened their 401k or their IRA decades ago. They never touched that form again. Here's the part most people don't know. The designation on that form overrides your will. It overrides your trust. Whatever's on that piece of paper says that's where the money goes. So I have two stories for you, and they're both families that I worked with. The first one is a client of mine. She was a retired teacher. She's 71 years old. Her name is Eleanor. She had a 403B from her years in the school district, about $500,000 sitting in it or so. We told her the years before she retired that her beneficiary designation needed to be updated. It was an old form set up when her kids were minors, and she agreed. She said she'd handle it, and then she didn't. She passed away unexpectedly about 4 years into retirement, and that account, unfortunately, passed to her grandchildren who were still minors. That triggered a tax outcome that was a lot bigger than it needed to be, plus extra court involvement, delays. The whole estate got messier than her family deserved, and that moment was caused by one form, 30 minutes of paperwork, and unfortunately, it never got done. The second story is a different family, a client named Doug. He's a retired engineer. Doug came in for what he thought was a routine review about 8 months into retirement. We sat down, we walked through his designations, and we realized two of his accounts still listed his first wife from a marriage that ended in 94. He updated everything that afternoon. 6 months later, Doug passed away unexpectedly from a heart attack, unfortunately. His two sons from his first marriage and his current wife, everything moved exactly the way he wanted. There was no delay, no dispute, no unnecessary tax. And it was because of a 30-minute conversation in our conference room. It was the same form, but completely different outcomes. The beneficiary designation is probably the single highest impact piece of paper in your retirement. And it's the one that gets neglected the most. So get it updated before you tell anybody that you've retired. Upgrade number 5 is your estate planning documents. Most people have a will, most people have a power of attorney, maybe they have a trust. And almost always those documents were drafted when their kids were young, and their financial picture looks nothing like it does today. Retiring changes your income sources, it changes your account structures, it changes the size of your estate. Your documents need to reflect where you are now, not where you were 15 years ago when someone signed them. And I'm sort of a weirdo. I'm a little different about this. I actually read estate planning documents. I read tax returns. I look at trust language, investment statements. I'm looking at whether everything is working together or whether the left hand has any idea what the right hand is doing. And I'll tell you, this is one of those things our families admit most. They know they need to update it. They've been meaning to do it, and it just doesn't get done. No one ever wakes up in the morning and says, I can't wait to update my will. I can't wait to update my trust. So we build it into the process, working with an attorney to update your will or trust, update your healthcare directive, your financial power of attorney, any remaining trust documents handled, not deferred. Without current documents, decisions get made by default, by a court, by whoever has the loudest voice in the room. That's not how these things should go. Upgrade 6 is your healthcare cost plan. Most people walking into retirement, they underestimate what healthcare is going to cost them. The Fidelity number that gets quoted is around $165,000 for a 65-year-old couple. And that's just the average. For the families I work with, it tends to be higher. If you're 65, this is the moment to actually understand Medicare. Not the brochure version, the real version. You're going to choose between traditional Medicare with a supplement plan or Medicare Advantage plan that bundles everything together. Those two paths produce very different out-of-pocket numbers across 20 years. And the choice you make in year one is hard to reverse later. Most retirees, they don't even realize that. And then there's IRMA. If your income crosses a certain threshold, your Medicare premiums jump. The upgrades that we talked about earlier, they start talking to each other again here. The withdrawal strategy from upgrade 1, that's what determines whether you're above or below those Medicare brackets. But if we do the right sequence, it keeps you under. The wrong sequence pushes you over, and now Medicare is costing you thousands more per year than it had to. It's really important to get this one right before you tell anyone you've retired. Real quickly, if you're watching this and you're already wondering how your own picture stacks up, there's actually a link below where you can set up a call with me. Feel free to click on it. I'd love to chat with you. Upgrade 7 is your cash reserves. During your working years, the rule of thumb was 3 to 6 months of emergency savings, and that was enough because a paycheck was always coming. In retirement, the cash needs to be thought about more deliberately. The starting point is a true emergency reserve. Call it 6 to 12 months in expenses in something stable and accessible. Not for your normal spending, for the unexpected, maybe medical copays you didn't see coming, home repairs, the roof, whatever. If your car breaks down, things that fall outside of your normal plan. Beyond that, if you've got known large purchases inside the first 2 years or 3 years, say a car or a kitchen model or a big trip you want to take with your family, that money in general needs to be set aside separately. We need to identify it, account for it before you start drawing from your portfolio. Because if it isn't, those purchases create unplanned investment sales, potentially at exactly the wrong time. This isn't about hoarding cash, it's about having the right amount accessible so the rest of your portfolio can actually do its job without getting interrupted every time something comes up. Upgrade number 8 is your actual spending. People enter retirement with a rough idea of what they spend. They've never tracked it because a salary covered everything and the details didn't matter. In retirement, the details matter a lot. Every dollar of spending comes from somewhere, and where it comes from determines your tax bill. An estimate from an online calculator is not really good enough for a 30-year withdrawal plan. You want to track your actual spending for at least 3 to 6 months. And it's your real number, not the one you guessed. Better yet, do it for 6 months before we retire. We call that rehearsing retirement. And the families who get specific about this early, they actually make better decisions all year long. And the ones who don't, they go on unintended spending sprees. They over withdraw, and a year in, they're pulling from the wrong accounts to cover the gap. Spending awareness, it sounds kind of boring. It's like one of these boring things we have to do in retirement. It's actually one of the most powerful ones on the list. Upgrade 9 is your Social Security analysis. Most people have looked at their Social Security statement and picked a claiming age based on the monthly benefit number. Bigger check at 70, smaller check at 62, or someone in the middle if they file at full retirement age. That's how most people decide. You see, that's not a Social Security strategy. That's just reading a number. The right claiming age depends on how the benefit interacts with your withdrawal plan, your Roth conversion window, your Medicare tax exposure, and how your Social Security is going to be taxed through provisional income calculation. If you claim at the wrong age and it doesn't just affect your monthly check, it sets your tax bill for the next decade. Most people are actually optimizing for the wrong thing entirely. The real question isn't which age produces the biggest check, it's which age creates the least damage on your taxes and the most long-term flexibility. For most families I sit down with, those are very different answers. So make sure to run the analysis before you start spending. Build the withdrawal plan around the claiming decision instead of making them in isolation and discovering that there's a conflict 3 years later, because by then there's nothing you can do about it. Upgrade number 10 is the survivor plan, and this is the one that bothers me the most. You see, we sit down with couples all the time where one spouse is kind of mentally checked out of this part of the conversation. The assumption is usually the same. We've saved well, the house is paid off, the investments are there, we get Social Security, it'll continue, the survivor will be fine. But also, almost nobody runs the actual numbers on what the tax picture looks like when one spouse is filing single. Let me tell you about Patricia and Doug. This is a different Doug. This is a couple retired together about 6 years ago. Patricia was a CFO and Doug was an executive at a manufacturing company. And they had about $3.2 million in combined retirement accounts. And most of it was traditional IRA. Doug passed away unexpectedly at age 68, and Patricia was 67 at the time. Within 18 months of his passing, her effective tax rate jumped. Same income coming in, same RMDs forcing distributions, but now she was filing single. Single filer brackets are compressed. The Social Security taxation threshold dropped. The Social Security taxation thresholds dropped. Medicare surcharges hit earlier and harder. She sat across the desk from me about a year after Doug's passing and said, I had no idea this is what it was going to look like. Here's what the math does by default when nobody runs the numbers in advance. Single filer brackets are tighter. RMDs continue on the full traditional balance. Medicare surcharges hit harder. The surviving spouse can end up paying a higher effective tax rate than the couple ever paid together on the same money with one fewer person in the household. If your traditional balance is large, that's not a minor inconvenience. It's a tax problem that lasts 15 to possibly 20 years. And for a lot of couples, this is the clearest argument for accelerating Roth conversions earlier, while both spouses are alive and the brackets are still wider. This whole extra tax problem, I call it the widow tax. And it's one of the most unfortunate parts of the tax code. But the good news is if we plan for it, we can alleviate some of it. And you want to model this before anything else gets locked in. You want to look at the structure you have right now, that it protects the surviving spouse, or if it quietly creates a problem that's sitting in the background waiting to surface. If the solution is more painful than the problem, then just leave it alone. But the one thing you don't want to do is ignore it. So now you've seen all 10, and here's why doing them first before you tell anyone matters as much as the upgrades themselves. You see, the moment you announce that you've retired, the calendar fills up. Trips get planned, dinners get organized, families start asking for help, old friends want to catch up. Spending decisions start happening before the structure underneath has been built. There's an old saying that I hear from retired families, and they tell me all the time, I've got so many things to do in retirement, I have no idea how I ever had time to work. And it's real. Retirees are busy. Every one of these 10 upgrades requires space for clear thinking. The window right before retirement and the first few months after is really the only time you get that space. It's really short and it doesn't come back. And here's the thing nobody's really saying, is most families have a CPA, they have an estate attorney, they have an investment advisor, and maybe even an insurance agent. 4 different people, but no one's looking at the entire picture all at once. The CPA isn't talking to the investment advisor, the estate attorney drafted the documents in '08 and hasn't seen them since, and the insurance agent doesn't know the withdrawal strategy. I ask this question of people all the time, when was the last time any of these people were in the same room together talking about your situation? And for most families I sit down with, the answer is almost never. And that's a gap that quietly costs families hundreds of thousands of dollars, not because anyone made a bad decision, but because no one was holding the whole picture together. And that's what these 10 upgrades are really about. Not 10 separate tasks, one integrated picture handled before the world has an opinion about how you should be spending your time. And so if you want to talk through how any of this applies to your own situation, there's a link below. I'd be happy to chat. There's no cost, no pressure, just a conversation. Hopefully this video is helpful. I really like making these, and I'll see you on the next one.